Rajesh Kothari is now joining us. He's Managing Director at Alfaccurate Advisors. Rajesh, good afternoon. Great to have you with us here. Thanks for joining us. I want to start with, we'll talk about what you like and what you want. We have a sense of that, and some of them are interesting names which we want to revisit. But I want to ask you about not a new name, but something I've not asked you before. Tejas Network. I don't know if you've, it's in that it's a IP/manufacturing kind of name, Tata Group company, of course, on the telecom side. Have you looked at it, Rajesh? Stock's up about 6-7%. Yesterday, there was a long-form piece in the Ken, the publication, talking about what's gone wrong and, the BSNL opportunity overhang, etc. It's been talked about quite a bit, but stocks come off very, very sharply. I don't know if you've looked at it in any detail at any point.
Hi. So, we have looked at this company and, in last, it is a very old company. So, a company has a long history of last 3, 4, 5 years in particular. A lot of developments have happened post the change in management. And of course, they are playing the global, I think it's a more of a play on the global infrastructure kind of a capabilities. Now, what happens when you play such kind of a global infrastructure capabilities? Please remember, these are not very high ROE, ROC businesses. At times it's like kind of a commodity business. You need to enter to make sure that you get the PQ. So you need to execute bulk, huge work, probably with lesser margin, at times lesser profitability, so that you get the future orders in the future bids. So currently we do not have any, holding in this company. So, I have a very, I would say, limited view right now.
Rajesh, so in the last 1 month, what have you been doing with your portfolio? The last time we spoke, you were telling us how you added or increased your exposure to specialty chemicals. EMS companies were on your radar and you were adding on to that, building materials, CDMO. These were some themes that we discussed last time. What else? Incrementally in the last 1 month, what changes have you made?
If you look at market, I think there are many, most of the players, they are talking about that the first quarter FY26 result season is over. And generally people say it's a kind of a muted number, 8-9% kind of a profit growth. If you look at the Nifty 500 companies, if you look at the Nifty, it is only about 6%, 7% growth. If you look at Nifty 500, it is about 9-10% kind of a net profit growth. But I think it's very important to look a little bit deep dive. And if you deep dive, then you will realize that 200 out of 500 companies, roughly about 200 companies, they have reported 15% plus EBITDA growth. So as I was saying, and I continue to maintain that from last 12, 18 months, I've been saying that it is a more of a stock selection, more of a stock specific market. It is a bottom-up approach. And there are enough number of companies which are delivering reasonably strong growth. If I look at my own portfolio, so we have a 2 portfolio, correct? AAA IOP, which is multi-cap. It is, delivered 20% plus net profit growth. And if you look at our AAA budding beast, which is a more mid and small, it is also reported 24% kind of a profit growth. And both these portfolios are reported, 18% plus revenue growth. So it means that there are enough number of companies which are delivering very strong growth. Primarily, the winners are specialty chemical, capital goods, auto ancillary companies, EMS plays, good hospitals, retail businesses, and CDMO. And if you look at most of our portfolio, they are a little bit more weighted, towards these names. Of course, the banking, primarily the large banks, IT and consumer, they are the draggers from the market perspective. But the good part is probably the worst is over in each of these 3 buckets. And hence from the market perspective, I think we have a very good, I would say reasonable good valuation with a upwards of earnings or trajectory for the overall market. And moment you do a little bit more deep dive, there are enough pockets where you can make 20% plus earnings growth over next 2 years.
Okay, interesting. Rajesh, hi, good afternoon. Good to have you on. I was just pouring through your latest fact sheets. And you have an interesting mix of consumer stocks and chemicals as well. Let me ask you about consumer first and then chemical. I think Arvind Fashions is something that you own in your mid and small cap portfolio. And in the larger cap space, you have names like Varun Beverages. I can see Tata Consumer here as well. So again, tell us, this whole hope of the GST benefit, festive season coming and overall sales and earnings improving, where do you expect it to show up? And specifically for Arvind Fashion, the company has just gone through a management change with the Ms. Jain taking over. So, what is your rationale, your thesis, X of the overall macro tailwind that the sector may enjoy?
Yeah, so, since now we are a little bit talking about stock specific, please put disclaimer because we might be holding for our PMS, AIF, and our personal portfolio. So kindly please put disclaimer. These are not the recommendations. So particularly for a company which you are talking about, yes, recently there is change in management and we are yet to meet them because she is yet to join the company. But the overall thesis is in the consumerism. I strongly believe that discretionary is going to grow faster than the non-discretionary. So if you look at our portfolio, most of them are not into FMCG categories, but they are towards apparel segment, luggage segment, building material segment. So I think discretionary is going to grow faster, number one. Number two, if you look at the premiumization, entire consumer, if you look at the different verticals, the premiumization is going to be the more important growth driver because the lower end of the demographic is the worst affected. And I think there is too much of competition at the lower end of the the value chain. Whereas at the upper end, for example, Polo or Tommy Hilfiger or such brands or CK brand, they are going to grow. They will keep growing it. And please remember, the per capita income inflection point has yet to come. So it is after probably another 1.5 to 2 years where actually hockey stick growth will start. So we are basically positioning our portfolio based on where we are going to see higher revenue growth and supported by better pricing power. So in a premium segment, you can have more pricing power compared to the lower end. And last but not least, where we see the significantly better profit growth. And therefore, our entire consumer space exposure is primarily focused towards the players who can benefit from that. Of course, the GST has been good news and GST further adds to that with the names which you're talking about. And that can, to a certain extent, definitely can result into better demand growth.
Hi Rajesh, good to see you again. What about tech? How are you all placed on tech? What are your preferences out there? Last, I think, couple of weeks or so, tech has actually outperformed. On good days, it tends to do relatively better. Yesterday, it had a big day as well. And on bad days, it's not falling that much. Do you think valuations have reached a level that you like it or you want to avoid it?
I think probably the downside is limited, but the problem is the upside is also limited. So the valuation support comes from free cash flow yield for the large companies, and therefore they are not going down beyond a point. But at the same time, the macro environment is still not kind of a green signal. So we are also kind of more of a wait and watch mode. But within the entire technology, we like the few companies where the revenue growth is at the top end and the earnings growth is also at the top end. So we prefer again there also to play the players like that. So we are more like a little bit underweight kind of a current portfolio weightage. I think there are many other sectors where the growth opportunities are going to be much stronger. Like for example, capital goods still continue to do well. I think select hospitals. Most of these hospitals are now cash rich. Most of them, and most of them they are expanding rapidly. Many of these hospitals in the first 6 months they drag your profits, and then as they get maturity, they starts getting added to the bottom lines. And therefore, you can see much bigger growth over the next 2-3 years for a few large hospitals, in the listed space. And similarly, CDMO is one such opportunity where at times there is a volatility because, the dispatches are kind of a, large lump sum kind of a quantities, and that results in the stock price volatility. But if you take a little bit longer view, CDMO also can be in a very good space to be in. So I think that interesting space, EMS, capital goods, in housing finance companies. Look at housing finance companies' growth, compared to the private sector banks. They are growing at 18, 20, 25%. So very healthy growth across the segments. So that's how I think we need to look at it to make a, what I would say, alpha for our investors.
Rajesh, you said, did I hear you right? Hospitals, you said?
Yeah.
Okay. Which name, just out of curiosity?
Would not like to specify the name, but the entire space looks very interesting. And in that, if you look at the top 5, top 6 hospitals chains,
okay.
The good thing which is happening is that most of these hospitals are now going the pan-India. So your risk to a particular region is also reducing across hospitals.
Yeah.
Be number 1, number 2, number 3, Look at Mumbai, the South players are entering Mumbai, and the Mumbai players are entering North. So, there is a geographic expansion, and that results into the de-risking of business, correct? So I think it's a very interesting space to look at it. Good ROC, good cash machines, and a healthy growth environment. And macro, of course, is in your favor because our penetration is still one of the lowest compared to the many other countries.
And it's a good hedge against medical inflation, right? I mean, I think that is a must. Better than, I guess, buying. No, it's not. I'm just joking, but I'm saying that, yeah, it's a serious consideration. Stocks have done extremely. Sorry, Rajesh, you're saying something?
Yeah, I think, at times the more traffic congestion results into more hospital opportunities. So yesterday I met one company, he said instead of 6 kilometers, we are open to open within 5 kilometers. Because at times 1 kilometer takes 35 minutes.
Oh dear. Oh dear. Oh dear. Oh, absolutely. Especially in in Mumbai, sometimes it's ambulance is stuck and it's crazy, the roads and traffic, etc. There's a company somebody mentioned, I don't know if you've looked at it, it's called GPT Healthcare, recent listing out of Kolkata. Again, it's a small company. Yeah.
We prefer the brands which are basically has a capability to scale across,
Okay.
That's the only way to leverage your brand.
Yeah. Absolutely. Got that. Rajesh, we'll leave it there. Thank you very much for joining us and interesting chat, as always, here on CNBC-TV18. Now, Hormuz is here with a spotlight.